This week, Fed Chair Jay Powell said the Fed will continue to raise rates until the job of fighting inflation is done. Joining me now, Apollo Global Management Chief Economist Torsten Slok. Torsten, the Federal Reserve is trying to slow down the economy, and we've seen some indications that maybe they're having success, but the labor market is still red hot. How does this play out?
Yeah, absolutely. I mean, in some sense, that's the whole problem, that the Fed would like to cool the economy down because that's the main way you can cool inflation down. Today, inflation at 8.5% is just too high relative to the Fed's target, which is 2%. So that's why the Fed needs to raise interest rates. That's why Jay Powell this week and also at Jackson Hole has been talking about we need to raise rates further, and several FOMC members also now pointing to 75 basis points at the next meeting. And all that is exactly to cool the economy down and also ultimately to slow the labor market down.
8.5 to 2, that's a fairly big delta, as you economists say. Jason Furman had a story or an op-ed in the Wall Street Journal saying that in order to achieve that slowdown you're talking about, we could face unemployment of 6.5% for 2 years. Is he being too pessimistic?
Well, the important part of that discussion is to ask the question, why did inflation go up? Did inflation go up because of demand, because of stimulus checks, more unemployment benefits, because people had more money? Or did inflation go up because of supply chains? In other words, was this because of COVID and because of the virus? Because if it was demand, then the answer is, well, then we need to destroy more demand, and the Fed needs to destroy demand and therefore push the unemployment rate up. But if inflation, on the other hand, went up because of supply chains, well, then maybe we just need time to resolve this problem because the supply chain problems are already getting better. And the Fed has already written a number of working papers that look at this. And there was a Fed paper from the San Francisco Fed that said about 2/3 of the increase in inflation was because of supply chain problems and supply issues, and only 1/3 was because of demand. So in some sense, the Fed's own answer is we don't quite need to get the unemployment rate all the way up to 6.5, because maybe just with time, some of these problems will resolve themselves once transportation costs come down and the supply chain problems get better. So there's an important debate in the economics community about that question, and 6.5% is certainly a lot higher than the 3.7% unemployment rate we have today.
So when you look at that debate, where do you come down, and where do you think the Fed will have to go as it weighs all these things?
Yeah, so the Federal Reserve themselves have a forecast where they say the unemployment rate will only go up to a little bit more than 4%. That's why estimates that are as high as 6.5, of course, are very controversial in this debate, because that will imply that we need a very substantial increase in the unemployment rate. And of course, we need, therefore, more unemployed people relative to what's required today. I think that the Fed is right. I think that we only need to see the unemployment rate go up a little bit more, because I do think that a lot of the reasons why inflation went up, they were associated with COVID. They were associated with supply chain costs going up. They were also associated with fewer people joining the labor market or more people staying at home because of long COVID. So that may take a little bit longer. But I do think that if we just wait and we will eventually see inflation come down, a lot of the inflation problems will resolve themselves. The question is if we get all the way down to 2, but we will certainly see inflation come down from the very high level of 8.5 of where we are today.
Okay, take all of this economics and let's put it on our portfolios, our viewers' portfolios. What does this mean for the stock market?
Well, in very simple words, the bottom line is that the Fed is trying to cool the economy down. So that's another way of saying the Fed is trying to lower the E in the PE ratio. And the consequence of earnings, therefore, are too high.
Yep.
U.S. companies, in the Fed's view, that's what they're saying, simply are making too much money. So a way to slow down the economy is to slow down hiring, slow down capex spending, and ultimately try to slow growth and therefore also slow earnings down. And if that's the case, then the answer to your question is that the risks to the stock market are still to the downside, simply because the Fed is not quite done yet slowing the economy relative to what they would like to see. Because remember, their goal is inflation needs to come down from 8.5 to 2. And if that involves a slower economy, it will also involve, therefore, slower earnings and therefore, unfortunately, slower corporate growth, in particular in earnings, but also in hiring and in capex spending.
Now, in the long term, all of that somewhat negative sounding stuff would actually be good for bondholders. But in the short term, it sounds like even more pain in the bond market?
Yeah, but that's exactly because in treasuries markets, of course, in particular, when you have a treasury portfolio at the moment and inflation is 8.5 and 10-year rates are 3.30, then you have, of course, a significant erosion of your portfolio.
Thanks very much, Torsten Slok.